Remember that accounting equation we talked about last video? Well, like I said, it's never going away. So today we're going to go into depth and we're going to look at how to increase and decrease values in our accounting equation. So let's go over some terms you most definitely will need to know, and you probably have already heard of them before. Those little rectangles, your debit and your credit card that you use to buy whatever you want. Well, now debit and credit will have a different meaning when it comes to accounting. Every account will have a normal balance. Normal in this case means what normally increases that account, a debit or a credit. These are going to show increases and decreases in an account. Let's start with the left side, our assets. They are going to increase with the debit, which means they have a normal debit balance. To decrease an asset, we are going to credit it. Let's take a look at an example. If I earn $2,000 for selling 3 dresses at my boutique today, then my cash account will be debited for $2,000 to show that increase. I made cash. Cash is what the company owns, and cash is my asset. Therefore, I'm going to increase it with the debit. Let's look at an example where you credit. For the sake of uniformity, we're going to look at the cash account. However, there are a bunch more asset accounts that we're going to go over shortly. In this scenario, let's say I'm paying $300 cash for my store's front window to be fixed. On the asset side of my equation, I am paying $300. So I'm decreasing my readily available cash. So I'm going to credit the cash account for $300. I keep saying account, and this simply is just a record that is going to show increases and decreases in a specific asset, liability, or equity. And all these accounts are going to be organized into what is known as a general ledger. The general ledger is like hundreds of books in the library. Your accounts are your books. So we mentioned how cash was an asset account. However, there are a bunch more asset accounts than just cash. So let's look at some common ones that you definitely are going to see when you account, and also that you're going to come across in the practice worksheet, which you can find down below for free. Equipment and supplies are 2 asset accounts because the business owns them. While I still have my supplies on hand, they are my asset. Equipment is my asset so long as it is still used and works for my business's operations. Later on, we'll get into more depth about what happens to equipment with depreciation, but let's not get ahead of ourselves. Today, we are focusing on simple asset accounts that increase with the debit. Buildings, land, and machines are more asset accounts because they are what the business owns. In my boutique, my sewing machine and the store I sell my clothing in are my 2 assets. Not everyone can pay for something up front with cash. Thank God for credit cards. But think about what a credit card does. If I don't have the readily available cash to pay for something in full right then and there, I can buy it and then I will owe that money later. Now, if you are a customer who comes into my boutique and you can't afford a $300 sweater up front with cash, but you buy it with a credit card, you owe my business $300. My business accounts for this, and the asset account accounts receivable. It is money I am expected to receive later on from customers. Since accounts receivable is an asset account, it will increase with the debit, but once my customers pay me back, they no longer owe me that money, so I decrease this asset account with the credit. Notes receivable run on the same concept as accounts receivable. It's money you are expected to receive later on. This time, though, it is a written promise and there's normally interest that you pay on it. If you are a retailer, you are going to sell merchandise. At my boutique, I am selling merchandise and products. Therefore, merchandise inventory is going to be an asset account. It's what I own. Let's jump over our equal sign now. This equation is like a mirror. Imagine if you wrote debit on the left and credit on the right of your asset side. Now fold it across the equal sign, and then your debit and your credit are going to switch on the liabilities and equity side. It is a reflection. So liabilities and equity are going to increase with the credit while they decrease with the debit. We went over that liabilities are what you owe someone else. The same way a customer promises to pay me back, I can promise to pay back a business. Accounts payable is going to be the typical liability account. It is the money you are expected to pay someone later on. Then we have notes payable, which is similar to accounts payable, wherein you have to pay someone back later, but this time it's a written promise and you pay interest on it. Unearned revenue is another liability account, but it's what I owe the customer this time. If I was a customer and I go online to a store and I pre-order a trench coat, then I paid for something that they have not yet delivered on. They owe me a trench coat. It is quite literally in the name, unearned revenue. You, as the business, got paid for something you have not yet delivered on and therefore are liable for it. So, of course, equity is where credits and debits can get a little hairy. Remember how we had to expand our equation to show the 4 parts that go into equity in our previous video on the accounting equation? We need to be careful with how we credit and debit each one of those sub-accounts. If you do not know the expanded equation of the accounting equation, then go back to my first video on the accounting equation where we go into that, because nothing going forward will make sense if you don't know what I mean when I say accounting equation. Let's remember what I said about the accounting equation being like a mirror. If liabilities increase with the credit and liabilities and equity are on the same side, then equity is going to increase with the credit as well. But this is where we have to remember the 4 components that go into my equity. Equity is what the owner keeps, so any money we are adding into our equity will be credited, but if we are taking away from our overall retained earnings, then we need to debit them. So let's look at common stock, the invested capital. This will increase with the credit because it is going to increase my equity and what I, as the owner, keep. Dividends are going to increase with the debit because it's money I'm taking away from my retained earnings. Debits decrease equity and dividends decrease my equity. Therefore, dividends increase with the debit. There is no mind game when it comes to revenue. Revenue is going to be increased with the credit because it is money that is coming into the business. Expenses mess with your head just like dividends. They increase with the debit because it is money I am expending and money I will not be keeping in my retained earnings. The name of our revenue account depends on what it is that I'm selling as the business, but here are a couple of the common ones: sales, rent revenue, interest revenue, and commissions revenue. What matters here is that they are all revenue accounts and that they are money that is coming into the business from something we sold. The list of expenses can go on and on. If you are doing your income statement, you'll probably notice that you have a lot more expense accounts than you do revenue accounts. And that's just because there are so many expenses in a business. There is your advertising expense, salaries expense, rent expense, repairs expense, utilities expense, insurance expense, and many more expense accounts that will be more particular to the business operations that are being carried out. Ledgers hold specific accounts and their approximate balances. The chart of accounts holds all the ledgers and identifies them with a number for each account. Typically, 101 to 199 will be your asset account numbers, 201 to 299 will be your liability accounts, 301 to 399 will be your equity accounts like common stock and dividends, 401 to 499 will be your revenue accounts, and 501 to 599 will be your expense accounts. Depending on the size of a business can have hundreds of accounts, which is why it's so important that we organize them with identification numbers. I'm pretty big on keeping everything organized, so maybe that's why I like accounting so much, because everything is so particular and there are no gray areas. Everything has its place. If your equation always has to be balanced, then what happens to one side must be reflected on the other side. If I debit an asset account, then I need to credit an account on my liabilities or my equity to make sure everything equals out. Take, for example, a sale at my boutique. A customer bought a handbag from me and paid cash. My cash account will increase with the debit because I just made money. But then what do I credit? Those principles we reviewed in the last video come into play here. I sold something that is a sale or a revenue, so I need to recognize that revenue and increase my revenue account with the credit. When it comes to debits and credits, there are 2 things that are most important for you to know. Total debits will always equal total credits, and when you are counting, debits must come first. This rule is known as double entry accounting because you put in 2 entries, a debit entry and its matching credit entry. Every transaction of a business will be recorded in what is known as a journal entry, a complete record of every individual transaction. Once you have journalized in the journal, you will post these entries to the ledgers that sum up each account's increase or decrease. Your journal entry will have a date of when that transaction took place, the name of each account that is affected by this transaction, and the debit and the credit that show how much each account increases or decreases by. But if you look at a journal entry, it is essentially just accounts and numbers, and it can get kind of confusing to know what the transaction was about after so many pile up throughout the day. So at the bottom of each journal entry will be a small description of what happened. Let's look at what a typical journal entry at my boutique for buying fabric and thread would look like. On April 4th, I bought $500 worth of fabric and $45 worth of thread. Let's say these fall under my supplies, and let's say I pay with a credit card. I have 2 amounts that I'm putting into here, but they are both debits because they are both increases to my asset accounts. So now we have to calculate what my credit would be, because total debits are my total credits. 500 plus 45 will get me to $545. That is how much I used on my credit card. Using my credit card means that I'm paying with money I do not yet have, therefore I owe it, and that's a liability. So that is my credit. I will debit $545 for supplies and credit $545 for accounts payable. At the bottom of my journal entry, I will write a quick blurb. Paid for fabric and thread on account. On account is another way for saying on credit, like using a credit card. So step 1, journalize. Step 2, post to the general ledger. Step 3 is to compile all the ledger accounts and sum it up in what is known as the trial balance, a tool that will show debits and credits between accounts are equal at a point in time. To prepare a trial balance, we will list each account with their balance, then sum all debits and credits together and verify that the debits and credits are equal. The trial balance is critical to assessing a company's financial situation, and it's a good checkpoint to make sure that debits and credits are equivalent. The debt ratio is also good for assessing a company's financial situation, and it's going to measure how high at risk that company is of not paying back its debt. So to find this ratio, we will divide total liabilities by total assets. This ratio shows the relationship between liabilities and assets for a company. How much of the company's borrowed money is being used to finance their assets? If the majority of the company's assets are financed by their liabilities, then they have a higher financial leverage. Leverage is your measured risk, so a higher leverage means that you are more at risk to not pay back what you owe. It is normal for a business to use liabilities to finance their assets. However, you want to make sure you have enough wiggle room. That way, when it comes time to paying back those debts, you are not going to be in a tight financial squeeze. We covered debits and credits, types of accounts, journalizing, statement preparation, and finding the debt ratio. That's a lot. Go down below, check out my free downloadable study guide on everything we just went over in this video and use it to help you ace my free practice worksheet. And of course, don't forget to subscribe for more mini lessons on accounting in pink.